Welcome to Kruse Asset Management's 60-second investing series. My name is Stuart Kruse, and I founded KAM based on the idea that we should take out emotions out of our investing and only make investment choices based off predictable, mathematical, and statistical advantages that occur in the stock market. Today we're going to discuss stock market pullbacks. Whenever there's weakness in the stock market, invariably I get calls from clients asking if we're doing anything to protect our portfolio. Short-term pullbacks are notoriously difficult, if not impossible, to predict. And in order to profit from any potential trade, not only do we need to get out at the right time, but we also need to find a good time to get back in, which is the harder part. Because by the time you feel more comfortable, the market is relatively too high. So ironically, people end up waiting for another pullback before they get back in. Timing both the sell and the buy points correctly can be extremely difficult. However, true to our philosophy, we ran the numbers to see if there's ever an advantage to getting out of the stock market during a downturn. What we found is that we shouldn't sell until the market is down at least 20% or more. Then we buy back in once it's rebounded 10% from its most recent lows. See, an average bear market is down around 35%. So if we get out at 20% level, we can still miss about half of the remaining downside and find a suitable reentry point. If we get out sooner than the 20% level, we've likely just sold during a typical pullback, and by the time we can get back in, we're worse off for the transaction. Not to mention, this can happen multiple times throughout the year. It doesn't usually make sense to change your long-term plan for a short-term problem. The bottom line is that if you're investing in the stock market, you should expect a certain level of volatility as part of the process. Trying to time the markets is generally a fool's errand, which is why most do-it-yourselfer investors can make so many bad trades along the way they actually cannot outperform inflation. The best rule of thumb is to stick to your long-term plan because the market has always rebounded after every pullback.